In this video, I'm going to simplify cracking the Bernie Madoff code. Bernie promised a consistent 12% return, and this promise was based on his ability to extract an edge from the options market. What was this edge? And why did it convince people to give him their money? Was there really an edge? My name is Carl Dahm, and I've been trading options online since the mid-1990s. And I use my experience to take trading courses advertised on YouTube. You know, the ones with the big promises. I actually take the course to see if these YouTube instructors are for real, or are they just a small-time Bernie Madoff? Subscribe to my channel and see my real results from taking online trading courses. Also, if you're interested in how I trade, with over 25 years of experience, check out my free proprietary course, and I left a link in the description below. Okay, let's get into Bernie. I'm going to simplify a technical subject. That is the subject of options. Now, Bernie said he was trading options in order to create this 12% return for his clients. He basically claimed that he could make money and be fully hedged at the same time. The trade structure he used on the surface looked like it would do just that. But first, let me simplify what options are really quick. There are 4 things you can do with options. So first, think of stocks. With stocks, you can either buy them and go long and hope that they go up, or sell them short and hope that they go down. With options, it's pretty much the same thing. You can buy a call, which is going long, hoping the stock goes up, or you can buy a put and go short, hoping the stock goes down. Now, with options, we need to add 2 more things. You can also sell a call, which is being short, or you can sell a put, which is going long. So here is what it looks like broken down. Buying a stock is a long position. Selling a stock is just short position. Now with options, buying a call is a long position. Buying a put is a short position. Selling a call is a short position. And selling a put is a long position. With options, there are only 4 positions you can have. And this is really all you need to know to understand the very basics. So what if you owned a stock for a long position, then hedged it by buying a put for a short position and selling a call for a short position? So here's what the position would look like. You can see here, you're buying the stock, that equals long. You bought a put, that equals a short. And you sell a call, that also equals a short. So you basically hedged off the stock that you purchased. This is what Bernie said he was doing. This is technically a stock that you can own that would be hedged. So let's break this down a little bit further. So buying a stock equals a long position. So for example, XYZ at $100 per share. So you buy the stock at $100, and then you buy a put, which is a short position. It's the opposite of the long. For example, buying the 100 strike put. So now if you own that, if the stock goes below $100, you're covered. You can't lose any money. And then you sell a call, which is also a short position. For example, you sell the 101 strike call. And the reason why you do this is to pay for that put that you just bought. It's financing. Having this short call, if the stock goes over 101, then the stock is sold at 101 and you make a $1 profit. So here's Bernie's position again. Long position paid $100. Short position, you paid, let's say, for example, $1 for that put. And then the short position on the call, you sell it for $1. So you break even on the process. So net, you're long at $100 and you're covered if the stock goes below $100. So you can win if the stock goes up to 101. So the only outcome here is that you make between $0 and $1 and you cannot lose. Your position is totally 100% hedged off. When people asked Bernie the details of his trading system, this is the explanation that he gave with these numbers that I just gave you, for example. This made enough sense and was complicated enough to fool people into investing with him. So what's really wrong here? Well, the problem lies within the prices of the options. Before the 1987 market crash, you could purchase a call and a put for the same price, everything else being equal. So for example, if the stock was trading at $100 and you wanted to buy a put that protected you at $100, it would cost the same as a call you could buy at the $100 strike. So they were equal in price. So for example, the put would cost $1 and the call would cost $1. They'd be equal. This made it more realistic for Bernie to show that he could make money no matter what the market did. The technical term for this position is called a risk reversal. After the 1987 market crash, options traders realized that the market typically goes up slow and down fast. You may have heard this analogy that the market goes up the stairs and down out the window. And this difference in market movement needed to be compensated for with options. So what happened was that puts have been typically priced higher than calls, all else being equal. So for example, if the stock is trading at $100 and you want to buy a put that protected you at $100, it would not cost the same as the call you could buy at $100. The puts are more expensive in price. For example, the put might cost $1.50 and the call might only cost $1. The technical term for this is called skew. So in the final analysis, here's really what the position would look like. Here's the math. You would buy a stock, which would be a long position, say at $100. Then you would buy a put, which would be a short position. You'd pay $1.50. And then you would try to finance that put by selling a call, and you would sell it for $1. But you notice that the call did not cover the price of the put. Net for a $100 position, you paid $100.50. And that is a built-in loss of 50 cents or minus 0.5% for every position that you put on. This is why the risk reversal doesn't have a built-in edge, this particular trade structure. Now, I want to be clear, I simplified the process in order to make it digestible for people that don't understand options. With a risk reversal, typically you use different strikes, and it's a little more complicated than that. But I just wanted to show the concept in as simple of terms as possible. And also, there's other underlyings like GLD, where the calls are actually more expensive than the puts. So there's always exceptions. But not understanding the details of skew and options pricing makes it possible to create a risk reversal trade that looks profitable in a way that makes sense. But when you take into account the reality of skew and proper option pricing, it makes it difficult to impossible to create a risk reversal that can be done with no risk and be a profitable trade. So you can see how Bernie was a fraud from the moment he started selling this concept. Harry Markopolos, the guy who was trying to expose Bernie 8 years before he was taken down, was trying to explain this concept to the SEC. If the SEC would have understood this simple concept, they could have gone after Bernie much sooner and saved a lot of people a lot of money. I guess it was too complicated. Hopefully, I was able to simplify this concept in this video. If you're interested in how I trade options, you can sign up for my free proprietary course by using the link in the description below.